Welcome to Chapter 5 of Mercury Investors Trading Program. Abdul is going to be explaining the different types of indicators that you can possibly use when entering a trade. I hope you guys enjoy.
So in this video, we'll be looking at what indicators are, and we'll be looking at a few indicators of my choice, which are Fibonacci, RSI or Relative Strength Index, Bollinger Bands, and how to use them together. So let's get straight into it. So what actually are indicators? Indicators are tools that traders use to assist their technical analysis, but they should never ever be the main reason you enter a trade. Most indicators such as moving averages alter with times, and big moves in the future cause changes to how they appear in the past, which is why they're hard to backtest. This is why they're known as lagging indicators. But let's take a look at Fibonacci. To simplify the term Fibonacci, a Fibonacci sequence is a sequence of recurring numbers. You use Fibonacci to identify a retracement, and it's best to use them to trade with momentum as they'll identify the pullback more clearly. So how do you actually plot a Fibonacci? Well, firstly, let me just tell you that the 61.8% to 78.6% retracement are the best levels to trade off. If price pushes beyond them, it's likely that a full reversal is going to take place and not a retracement. So this is what it looks like to plot a Fibonacci, as an example I did for myself earlier today. So here you have an uptrend. So you take your Fibonacci tool, you identify the lowest low where the reversal begins, and then you take it to the first higher high, as you can see here, where the 0 is. And then you see a 61.8% retracement there, satisfy the move, pushes beyond the 0%, and then that means that the Fibonacci has been completed. So you create a new one starting from the higher low, take it to the higher high, and here you see a nice 38.2% retracement on the last one, and a lot of resistance at the 23.6%. It pushes beyond the 0, so you take it and you start again, nice here, to there, and you get a nice 50% retracement with a morning star on that actual 50% retracement. And these are on 4-hour candles. So then one more here, you take the low, you take it to the highest point in the move, and then you can identify that you get a nice 50% retracement there, just misses out on the 61.8% retracement here, as you can see here, and you see a nice push up. That one just about clears the 0% level. So let me show you the example that we'll be using on this analysis for what we'll be using for the rest of the indicators. I've chosen this at random, complete random, so it's not one that I found worked really well. This is just a live demonstration. So here you have USD CAD 4-hour chart, and you have a downtrend or a bearish move. You take it from the previous lower high, you take it to the lower low, and you see here you get 61.8% retracement. You have a lot of resistance at the 50% retracement level there as well. So what does that mean? It means that we're likely to see a nice bearish push down to at least 0%. And that's where we'll be looking to take profit in the first place. So let's take a closer look. So here you have your previous lower high, here you have your lower low, and you see the levels are done on their own. These are the stock Fibonacci levels, but these two are the best to trade off. And this is a prime example. Why? Because you have two nice little candles here, and you have a perfect 4-hour rejection off the 61.8% retracement, and you see price already moving down. It's likely there might be a little bit of resistance around this level before pushing further down, but that's the case. And here you actually have tweezer tops there before making an even further push down. So, relative strength index. This is basically used to identify when a currency pair is overbought or oversold. So any of you who have studied economics will know when there's a lot of stock in the market, when there's a lot of supply but not much demand, you'll see price go down. And when there's a lot of demand but not much supply, you'll see price go up. So this is basically an indicator to demonstrate that. When there's low supply, or when it's overbought, you'll see price go down. And when there's high supply or oversold, you'll see price come up, like here. So here you have price is oversold here. You see it lines up nicely with the Fibonacci. And before we go into this any further, I'd just like to mention that with the relative strength index, overbought and oversold levels are here and here. So anything in between, price is moving normally. 70% upwards is overbought, 30% downwards is oversold. So here you have your oversold level lining up with the end of the Fibonacci. But this is even better yet, because the 61.8% retracement lines up with an overbought level. So then you see the start of a bearish push down. Onto Bollinger Bands. These are personally my favorite to stay in a trade. Once I'm already in a trade, I use these to stay in or know when to get out. So they're effectively a set of boundaries which price stays within. They have a central moving average as well. They're best used to explain pullbacks in a movement, or heavily bullish movements need a pullback and heavily bearish movements need a pullback before they can push forward further. And Bollinger Bands demonstrate these really nicely. But one thing I'd like to say is when all these confluences line up together and come together, you'll see a really, really nice trade setup, as I'm about to show you. So look here. You have your Bollinger Bands, your boundaries here. Price abides to them quite nicely. Price goes out, it pushes back in. Price goes out, pushes back in. Price goes out, pushes back in. Price goes out, pushes back in. So you want to go with momentum, as I said. So here's your Fibonacci extension level in here to there. As you're going with momentum, you have a downwards trend line. Like that. First touch there, second touch there. Third touch was this nice little one there. And you also have your relative strength index here, showing you that price is overbought when it leaves the Bollinger Bands, and it tells you price is oversold when it leaves the Bollinger Bands, and overbought when it leaves the Bollinger Bands here, as well as touching the trend line and the Fibonacci. So when they all came together, you knew this was definitely the right time to put a sell on. So just before we get to the conclusion, I'd like to say keep in mind that you should never ever trade purely off indicators, as a lot of them are actually lagging, so you can't backtest them to be too accurate. Indicators are nothing without price action and technical analysis. So in chapter 6, what you have to expect is how to manage a trade, when to know how to take profit, when to take profit, how to set your stop losses, and risk management in general. So we appreciate you for watching, and we hope to see you in chapter 6. Thank you.